Good day, everyone. Uh, my name is Olawale Akimbami. Putting this uh, video up, or this lecture for the consumption of some of our students that may be preparing for their WAEC on financial accounting. So I'll be rolling out some of these videos in the course of this lockdown for the benefit of some of the students. The lecture is targeted at WAEC, though there are other people that may make use of it if you feel it is relevant to you. But this lecture is prepared basically using the WAEC syllabus. WAEC calls the subject financial accounting. I call it bookkeeping and accounting. So what we will be looking basically are the topics that WAEC expects some of the students to know. So this lecture is compiled by me and is also going to be delivered by me. This lesson 1, I titled it Introduction to Bookkeeping and Accounts. And what are we going to be looking at? Even though there are some little things I included just to broaden the knowledge base of our students, they might not be relevant for the purpose of their examination. But being a commercial student and somebody who might be aspiring to study accountancy or a related course in the future, I think there are basic informations they need to know, which I've also included just for their personal consumption. The lesson outline will be, we're going to be looking at the definition of bookkeeping and accounting. We'll look at the difference between bookkeeping and accounting. We're going to be looking at regulation of accounting profession in Nigeria. Then we will look at users of financial statement stroke information. We look at source documents. Then we look at few basic terminologies used in accounting. Then of course we'll be looking at accounting principles, concepts, and convention. Okay. By way of definition, bookkeeping at times is bookkeeping and accounting are often used interchangeably by people, but the truth is both of them mean entirely different. But of course, they are dependent on each other. Accounting depends on bookkeeping. Without bookkeeping, there can never be an account, because accounting extracts its information from bookkeeping. Accounting is broader and more analytical in nature. It includes the design of accounting system, which the bookkeepers use, preparation of financial statement, audit, custody, income tax work, and analysis and interpretation of accounting information for internal and external use as an aid to making business decision. The whole essence of producing any kind of accounting information is for the purpose of the users, and for these users to be able to make informed economic decision. That is the main idea, the main objective of accounting information. Now, this accounting work requires more skill, experience, and imagination. The larger firm, the greater is the responsibility of the accountant. It can be said that accounting begins where bookkeeping ends. Bookkeeping provides basis for accounting, just like I said earlier on. The basis of any accounting information starts from bookkeeping. We can invariably say that bookkeeping is the foundation for any accounting information. Now let's look at the definition of bookkeeping properly. Bookkeeping is mainly concerned with recording of financial data relating to the business operations in significant and orderly manner. It is concerned with the permanent record of all transactions in a systematic manner to show its financial effect on the business. It covers procedural aspects of accounting work and includes record-keeping function. It is the science and art of correctly recording in books of account all those business transactions that result in the transfer of money or money works. It is mechanical and repetitive. This work of bookkeeping is of clerical nature and usually entrusted to junior employees of account sections of a business house. Nowadays, most of the bookkeeping work is done through computers and electronic device. Now, let me break all of this down. Let me paint a picture to us. For some of us that have bought things at supermarkets, when we enter supermarkets, after we have picked whatever we want to pick, there are people we see at the counter. They attend to us, they ask you what you have bought, they key in the information, what you have bought on the system, and they generate a document for you. Now, what those guys are doing, those guys you see, what they are doing is called bookkeeping. Now, let me create another illustration. Virtually, most of us have gone to do transactions at the bank. When you enter banking hall, you feel a teller. You give to the teller at the counter. He collects your money from you. The process, what those guys are doing at the counter, is called bookkeeping. They are doing what is called bookkeeping. You can see that anytime you go to this bank or you go to some of these stores to buy things, you meet the same face, at least for a reasonable period of time. If the staff is not changed, you meet the same person. They are doing the same thing. That's why we said the work of bookkeeping is clerical in nature and usually entrusted to junior employees. Then it is mechanical in nature. It's something they do over and over. It's a repetitive job, kind of. So all the information these people are generating at that level, issuing of receipt, issuing of invoice, tellers in the bank, when you want to make withdrawal, you write your check, you submit it at the counter, they give you your money. What they are doing at that point is called bookkeeping, right? I think that is clear enough. Then let us look at the definition of accounting. Accounting is defined as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events, which are in parts, at least of financial character, and interpreting the result thereof for the users of financial information. Okay. Now, from this definition, we notice that the word A read, recording, classifying, summarizing, those words are very key when you are defining accounting. It is an art of recording, classifying, and summarizing in a significant manner. And in terms of money, transactions and events, which are in part, at least, of a financial character, and interpreting the results thereof for the users of financial information. Like I said earlier, the ultimate of accounting information is for users of such information to make informed economic decision. Now, let us look at each of these words I underlined one after the other. Accounting and art of recording, classifying and summarizing in a significant manner and at terms of money. Whatever activity that happen in a business environment that you cannot translate into financial terms, it is not recognized by accounting. But of course, in advanced accounting, there is a way we look at other factors that affect our businesses other than the quantitative factors. There are other qualitative factors that businesses are mandated to report, but that is not for the purpose of this lecture. But for the purpose of this lecture, whatever that doesn't have financial nature, that cannot be translated into Naira and Kobo, or as the case may be in Nigeria or any other currency, it is not recognizable in an accounting. Now, from this definition now, let us look at some of the attributes of accounting. Let's look at some of the attributes. Okay. Okay. From the above definition, let's look at the attributes of accounting. Number one, accounting is an art. Accounting is classified as an art as it helps us in attaining our aim of ascertaining the financial result, that is, operating profit and financial position through analysis and interpretation of financial data, which requires special knowledge, experience, and judgment. Number two, it involves recording, classifying, and summarizing. Recording means systematically writing down the transactions and events in account books soon after their occurrence. So when transaction happens, you have to record them, classify them, and summarize at the end of the day. For example, if sales transactions happen, for example, credit sales transaction happen from different customers, you have to record, classify them into different ledger. At the end of the day, summarize each of those ledger to know what each person is owing. Now, we'll see some of these things in the course of the lecture. Then number three, from the above definition, we see that it records only those transactions and events which are of financial character. I said earlier on, anything that does not have financial nature, it is not recognized in accounting. If an event has no financial character, then it will not be measured in terms of money. Then it will not be recorded because it cannot be quantified. So accounting basically is interested in money. Then number four, it is the art of interpreting the result of operation to determine the financial position of the enterprise, the progress it has made, and how well it is getting along. Now, after putting all of this, all of this information together, the idea is to interpret it to the users of those information so that they can see the progress and how well the company is doing. Quickly, let's look at a quick one. Let's look at the difference between bookkeeping and accounting. Bookkeeping is concerned with recording of transactions, while accounting is concerned with the summarizing of the recorded transaction. Bookkeeping is concerned with the recording of the transaction. Bookkeeping records the transaction. Bookkeeping records the transaction. Then whatever bookkeeping has recorded, then accounting is concerned with is concerned with summarizing the recorded transaction. That's one of the major difference. Then number two, the work of bookkeeping is mainly routine and clerical in nature, and it is increasingly being done by computer. Computer is taking over so many accounting functions. Like when you get to so many supermarkets or so many small businesses, when you meet an invoicing clerk, you see that what they will give you, instead of giving you a manual receipt or a manual invoice, what they will give you is an electronic invoice or an electronic receipt. What they are still doing is bookkeeping, but it's being done electronically now with the advent of computer. But that's the more reason why some of us need to set up as accountants before computer will take over our job. Because some of these functions, you don't even need to have an accounting background, an accounting knowledge before you can do them, especially the bookkeeping functions. The basic thing you need is how to use computer. Those software have been automated to the extent possible to make sure that the transactions are done without each. It's even error-free, it is more reliable, it's accurate, so it's good for the business. Then the second difference between bookkeeping and accounting, we said the work of bookkeeping is mainly routine, clerical in nature, and it's being done by computer. The accounting, the work of accountant requires higher level of knowledge, conceptual understanding, and analytical skill. The truth is, as much as anybody can do a bookkeeping job, not everybody can do an accounting job. You must have the skill. You must be trained. You must be a trained accountant. You don't necessarily need to be trained before you can, do the work of a bookkeeper these days, especially with the introduction of computers. But accounting, you have to have the skill, analytical skill. You have to be a trained accountant, and as a matter of fact, you have to be a professional before you can do an accounting job. And number three, bookkeeping constitutes the base for accounting. Like I said earlier on, the basis or the foundation for accounting is bookkeeping. Then accounting starts where bookkeeping ends. That is, the accounting makes use of the information generated by bookkeeping and summarize it to make financial information or financial statement. And number four, bookkeeping is done in accordance with basic accounting concepts and convention. The process of doing the bookkeeping, there are basic accounting concepts and conventions that must be followed. Then number four, accounting, the method and procedures for accounting for analysis and interpretation of financial statements vary from firm to firm. The truth is, bookkeeping, you follow the same procedure irrespective of the industry you're operating from. We follow the same procedure, there are convention. But in accounting, there are specific provision of international regulatory bodies, specific provision of local legislation on how accounting information must be provided. For example, in oil and gas, the way the financial information will be presented is different from the way it is presented in the banking industry. There are some level of disclosures that must be, present. There are formats that are specific for industry. But the basic thing is that bookkeeping is the same everywhere. Then financial statements do not form part of bookkeeping. When you are doing bookkeeping, you don't prepare financial statements. You don't prepare financial statements. They are just basic documentation of financial transactions that happen within the organization. Meanwhile, in accounting, financial statements are prepared in accounting process from the bookkeeping record. So the information generated by bookkeeper is what the accountant will use to generate its financial statement. And lastly, financial position of business cannot be ascertained through bookkeeping. By merely picking up bookkeeping records, you cannot ascertain the financial position of any business. But from accounting information or from accounting, financial position of a business can be ascertained. These are the major differences that are between bookkeeping and accounting. Okay, let's look at stages of accounting. Accounting has the following stages. That's the following stages. Number one, transactions of business that have at least in part a financial character are identified and recorded. The recording is done in the manner which identifies the different classes and types of transactions. Then the results recorded are summarized in such a way that the owners or other interested parties in the business can see the overall effect of the transactions. The statement prepared by the summarizing process is known as financial statement, which will show the profit or loss made by the business over a period of time and the total capital employed in the business. Such financial statements are used by management to make decisions. Then in diagram formats, we can represent these stages or the flow of accounting information in this order. We can say source documents, from source documents, you transfer your records to books of original entry or prime book of entry. Then from books of original entry, from books of original entry, you go to ledgers. Then from your ledgers, go to trial balance. Then from your trial balance, then to financial statements. These are the stages of accounting information or process of accounting information. The source documents to books of original entry, to your ledgers, to trial balance, and to your financial statements. So each of these is what we are still going to look at in the course of these lectures. We might not look at all of them in today's lecture, but in the course of the subsequent lectures, we look at some of these information. Briefly, let's look at functions of accounting. The following are the main functions of accounting. Number one, keeping systematic records. Accounting is done to keep a systematic record of financial transactions. That's the whole essence of accounting, is to, keep a systematic record of financial transactions. Then number two, protecting and controlling business property. One of the functions of accounting is to protect the properties of the business, to know who is in charge of what asset, to know which branch is in charge of what assets, and to monitor the disposal or acquisition of a new asset. Accounting helps to see if there is no, to see that there is no unauthorized use or disposal of any asset or property belonging to the firm. Because proper records are maintained, accounting will furnish information about money due from various persons and money due to various parties. The firm can see that all monies due to it are recovered in due time, that no amount is paid unnecessarily. That's what's one of the functions of accounting. For example, if you are making payment to your supplier, because you have proper accounting record in place, it will help you to know whether that supplier you are paying the company is actually owing that supplier from the record of the books that you have kept from the supplier's ledger. You'll be able to know so that you don't unnecessarily pay somebody you are not owing. Ascertaining the operational profit or loss. One of the major reasons for preparation of accounting information is to ascertain whether the profit is making, whether the business is making profit or not. So this is one of the things accounting helps you to do. And this is done by keeping a proper record of revenues and expenses of a particular period, and then matching them with the revenue with the corresponding cost. So by the time you put all of this information together, your revenue against the expenses, if the revenue is more than expenses, that is profit, and if the expenses is more than the revenue, that is loss. So without accounting record or without bookkeeping, you cannot really, ascertain this operational profit or loss. Then accounting also helps to ascertain the financial position of the business. If you want to know where your business stands or the worth of your business, it is from only accounting information you can get. This is one of the things accounting information helps you to achieve. You can only ascertain the financial position of your business from, accounting information. A balance sheet is prepared to ascertain the financial position of the firm at the end of a particular period. It shows the value of the assets and the liabilities of a business entity. That's what balance sheet helps you to do. Then let me also say here that the name balance sheet, for the purpose of this class, well, you can call it balance sheets for the purpose of this O-level examination. But this balance sheet is now called, by introduction of IFRS, is now called Statement of Financial Position. Statement of Financial Position. So for some of us still at O-level, so if you see anywhere you come across Statement of Financial Position, bear in mind that they are referring to balance sheet. Then our regular profit and loss account also has been changed to what is called income statement. Income statement. Or statement of comprehensive income. Take note of that. So, but for the purpose of this class, we'll be using the name interchangeably: profit and loss accounts, income statement, then balance sheets, statement of financial position. So let's take note of that. And lastly, accounting information facilitates rational decision making. Accounting facilitates collection, analysis, and reporting of information at a required point of time to the required level of authority in order to facilitate rational decision making. The whole essence of accounting information is to make an informed economic decision, either by management or by whoever that is making use of the financial statement. It is to make decision. It is to make business decision, to make rational and economic business decision. Okay, quickly, let's look at advantages of accounting. The following are the advantages of accounting. Number one, maintenance of business record. Accounting helps you to maintain the record of your business. Remember, not just any hour record, but records of transactions that have financial nature. All financial transactions are recorded in a systematic manner in books of account, so that there is no need to depend upon memory. It is impossible to remember the business transactions which have grown in size and complexity. This is the bane of so many small businesses. A lot of business owners rely on their brain. Everything they are doing is in their head. They don't keep record. They don't have bookkeeping record. They don't have financial record. And this thing is killing a lot of businesses, because when you have business, when you have your books kept, your financial records kept, it helps you to make some decisions. For example, if you have a profit and loss account that shows how you have been spending, it will help you to look at some area of expenses, whether to cut your expenses or not, if those expenses are not necessary. But if you are relying on your head alone, you may not be able to, fully have grasp of some of these things. So it is very important that we embrace the maintenance of our business record. Advantages of accounting. Number 2, preparation of financial statements. Proper records of transactions facilitate the preparation of financial statements. That is the trading profit and loss accounts. Like I said earlier on, the trading profit and loss accounts is now statement of comprehensive income or income statement. And your balance sheet. Balance sheet is now, I deliberately left it as profit and loss for the purpose of this class and balance sheet, so that we will not be confused. Number 3, comparison of results. Accounting information help you to compare results. Maybe year-on-year results from your company. You compare, this year record with last year record, or it helps you to compare with, the same company in the companies in the same industry with you, so that you will be able to know whether you are doing well. Then there are industry setup criteria. You can also compare your record with to know whether you are doing well within the industry. Your accounting information helps you to achieve this. Then decision making. Accounting information helps the management to plan its future activities by preparing budgets and coordination of various activities in different departments. Accounting information helps to make, decision. Then advantages of accounting. Number 5, evidence in the legal matter. So if there is dispute between you and any of your clients, your supplier, or your bank, accounting record can be used in a court of law as evidence. For example, maybe you take a loan from a bank and there is a dispute about how much you are still owing them. Maybe there are some of your payments they do not capture. So your accounting records might serve as a good evidence to show how you have been paying with, necessary documents, necessary supporting document, necessary source document as evidence that you have actually paid that money. It can be used as evidence in a legal matter, even if the matter doesn't go to court, within a dispute between you and your customer, you and your supplier, you and people that are dealing with your business. I can remember very well while I was working in one company, there is this supplier that came one day and said the money we are owing him is more than what is showing in his ledger. It's okay, no problem. So what I did was I brought out the ledger, then we start looking at all the supplies and all his payments, one after the other. Now, what actually exonerated my company then from that argument or dispute is the accounting record we're keeping, the bookkeeping we're doing. That is the source document of all the money he was coming to collect. Every time he comes to collect money, he signs payment voucher. We make sure he signs payment voucher. That's the normal thing to do. If as an accountant you are not doing that, you are seizing on the gunpowder. The day you see trouble of, that source document will rescue you. you understand the importance of making sure that the people that come collect money from you sign before you give them the money. So I brought out all the payment voucher. Said, whose signature is this? We check all the payment voucher one by one on the statement, and eventually found out that all those money, it was the one that collected it. His argument was that there are monies that was posted on his accounts that he did not collect. So at the end of the day, I said, oh, is there anyone that is left out? He couldn't see anything again. He was just looking at me. So you can imagine if this kind of information is not available, we will have been in serious trouble. Then accounting provides information to interested parties. There are so many people that are interested in accounting information. In the course of the lecture, we're going to look at the users of financial information. Accounting provides different information to different users, ranging from owners, creditors, management, employees, customer, government, all of them. Accounting provides various information to all of them. So all these users can get financial information about any organization. So it provides information to them, so they make use of them to make decisions. We'll look at some of the decisions they make in the course of the teaching. Financial accounting helps in taxation matters, because it is from your financial record you compute the amount of tax you are going to pay. So if there is no accounting information, there is no way the tax collectors, the revenue services, will know how much you are going to pay as tax. So the tax authority depends on the accounts you maintain so that they can compute your tax. Valuation of business. When maybe later on you want to sell your business, one vital information that will help out is your financial accounting information. So it will help you to properly value the business. When the business is about to be sold, the accounting information can be utilized to determine proper value for your business. So these are the advantages of accounting information. As good as accounting is, it has some limitations too. It has some hiccups. So let's look at those limitations too. These are some of the limitations that accounting has. Number one, accounting information is expressed in terms of money. So invariably, the accountant measures only those events that are of financial nature. That is, those events that are capable of being expressed in terms of money. Non-monetary items or events are not measured and recorded in accounting. They are not recorded. But like I said earlier on, in advanced corporate reporting, you see how information that are not, some of these limitations are what the regulatory bodies are working on to make sure that we have a total accounting information. There are some things you need to disclose, even though they don't have the financial nature in your business. And accounting information is based on estimates. Some accounting data are based on estimates, and estimates may be inaccurate. Yeah, estimates may be inaccurate. Then accounting information may be biased. Accounting information is done without personal influence or bias of the accountant. In measuring income, accountants applies a choice between different methods of inventory valuation, depreciation method, treatment of capital, and revenue items. Hence, due to lack of objectivity, income arrival may not be correct in certain cases. Now, what we are saying here is that there are some, different methods in applying to arrive at some accounting information. And if two accountants prepare the same information using different methods, you'll find out that they will not arrive at the same thing. For example, if if I prepare a financial information like a P&L account, and I use a depreciation method of a straight line method of depreciation, and another person does the same account using reducing balance method, you see that at the end of the day, two of us will arrive at two different answers. So that is what we mean by accounting information may be biased, because there are so many different, like the same thing in inventory valuation, we have so many different method of inventory valuation. We have LIFO, FIFO, though LIFO has been abolished by introduction of IFRS. We have FIFO, we have weighted average, we have them. So these are subjective, methods of arriving at some things. Then we have fixed assets are recorded at the original cost. The value of fixed assets change over time, and so there may be a great difference between the original cost and current replacement cost. Balance sheet may not show true and fair view of financial position on particular dates. Now, some of these, for the purpose of this class, just take note of some of these limitations and work with them for the purpose of this level. Now, some of these limitations is what the international regulatory bodies have actually worked on over time. I don't want to go into details of how they have tried to resolve some of these limitations. Like, for example, fixed assets are recorded at the original cost. So many things has changed. You don't necessarily need to record fixed assets at the original cost. Fixed assets is recorded at the fair value now. It's recorded at a fair value. Okay, that's by the way. Accounting can be manipulated. Accounting information may not be used as the only test of managerial performance, as profit can be manipulated or misrepresented. A lot of accountants do this. We call it window dressing accounting. The money as a measurement unit changes in value. The value of money does not remain stable unless price level changes. Consider the measurement of income. The accounting information will not show true financial results. This particular limitation also has been resolved because there is a way you do an accounting in a period of inflation. But for the purpose of this class, we will not, delve into the details of that. Okay. Quickly, let's look at characteristics of accounting information. Characteristics of accounting information. The various characteristics of accounting information are as follows. Number one, relevance. Like we said earlier on, there are so many users of accounting information. So when you are providing accounting information to a user, you must bear in mind the specific information that user is looking for. So make sure that whatever information you are providing, for that user is relevant for the decision making of that user. It should be relevant for the user. The information should be relevant in order to influence the economic decision of the users by helping them to evaluate the events at all times. Accounting information has a bearing on decision making by helping investors, creditors, and other users to evaluate past and future events, confirms or corrects prior expectation. The relevance of information is affected by its nature and materiality. So it is important that this information you're providing to these people is relevant to them. For example, now, the information that government need or revenue collector needs, like FIRS, Federal Revenue Services need, the information they need in your financial record is different from the information an investor needs. So they are looking for different things. Federal Inland Revenue is looking for the amount of tax they're going to collect from you, while an investor is looking for how, as much as how profitable the business is, what can he get, how much can he get as a return on his investment. Of course, the same thing with creditors and other people. So number two, reliability. Accounting information has to be reliable. It has to be dependable. It has to be something so people, the users of the information, can depend on to make decisions. So if an accounting information is not reliable, it can help the user to make wrong decisions. So it is very important that accounting information is reliable. Then comparability. Accounting information of an enterprise is useful when it is comparable with similar information for the same enterprise or in other periods of time, similar information regarding other enterprises at the same time. So you must be able to compare and contrast your accounting information. For example, you should be able to compare your turnover for this year with turnover for last year to see whether there is an increase or decrease. That's why if you see some of this financial information, you will see the current year, you will see for the last year. So you're trying to compare the figures to see an improvement. Then understandability. Information should be readily understandable by users who are expected to have a reasonable knowledge of business, economics, and accounting, willingness to study the information with reasonable diligence. So when you're providing accounting information to the users of the information, with little or no guide, they should be able to understand what you're saying. Accounting information should not be presented in a complex manner that your attention may necessarily be needed for the user to understand it. It should be presented in a simple and understandable manner. Timeliness. A good accounting information must be timely, because if it is not prepared on time, it might not be relevant again. It might not be useful for the purpose of that decision that has to be made. Accounting information should be made available at appropriate time without delay for prompt decision making. Cost benefits. Now, the cost of preparing an accounting information should not outweigh the benefits. It should not outweigh the benefits. The emphasis is on cost-benefit consideration, and the benefit derived from information should normally exceed the cost of providing it. Then verifiability. Verifiability ensures the truthfulness of the recorded transaction, which can be checked by persons other than the accountant himself. Every information that you have provided on that financial statement must be backed up by necessary supporting documents. If at any point anybody other than you, that is the preparer of the information, want to check anything, they must be able to fall back on something to actually verify the correctness or the truthfulness of the information you have provided. Neutrality. In the course of preparing your financial statement, an accountant should try as much as possible not to be biased. You should not be biased. You try as much as possible to be objective in the preparation of your financial information. And completeness. Completeness means that all material information that is necessary to investors, creditors, or other users for assessing financial position and operating results of the organization has been disclosed in the financial statements. You must make sure you disclose all relevant information. It is very, very important. It's very key. It is very, very key. Now, quickly, let's look at the regulatory framework of accounting profession in Nigeria, regulation of accounting. I classified this into three major class. Number one, I call it professional bodies in Nigeria. We have local legislations, and then we have international regulatory bodies. The two professional bodies we have in Nigeria are ANAN, and we have ICAN. These are the two accounting bodies we have in Nigeria. Any other one, I don't know of it. These are the two accounting bodies. Then there are other accounting bodies in the world, all over the places. We have, Institute of Chartered Accountants of England and Wales, SCA EU. We have CPA in US. You have so many of them. You have CIMA, you have CFA. You have so many of them. But as far as Nigeria is concerned, the two major professional bodies that is in charge of accounting profession in Nigeria are ANAN and ICAN. Then we have local legislations. We have, CAMA, that is our local law that is regulating accounting profession. We have CAMA. We have Financial Reporting Council of Nigeria. We have FRCN. We have Banking and Other Financial Institution Act, BUFIA. We have, insurance law. We have laws that are regulating oil and gas industry. We have so many laws that are regulating specific sectors. So these are the local legislations and bodies. And we have international regulatory bodies. We have IASB, International Accounting Standard Board. We have IFAC, International Federation of Accountants. We have ABUA. We have so many of them, but these are the two major international regulatory bodies. So these are the regulations of accounting profession in Nigeria. I just deliberately talked about this for consumption. Okay, let's look at users of financial information. We said earlier on that from the definition of accounting, we said that the essence of, or the objective of preparing accounting information is for the users to be able to make economic and informed economic decisions. So let's also look at some of these users and the specific areas that are of interest to them. Number one, owners and shareholders. The primary aim of accounting is to provide necessary information to the owners relating to their business, especially the profitability. Profitability. The shareholders are interested in, how much dividends is going to be paid at the end of the year. The owner is interested in, how much is the business making, what's the worth of my business now. There are so many other information that they will need. Then managers in large business organizations and in corporations, there is separation of ownership and management functions. The managers of such businesses are more concerned with the accounting information because they are answerable to the owners. So in other words, to managers in big corporations, they use accounting information to provide stewardship. They also use information to make decisions also at the end of the day. They want to help the owners to maximize their wealth, to maximize their interest in the business. Then they also, make use of it to make some decisions in the day-to-day runnings of the business, on how to improve sales and so many other areas. There's prospective investors. The persons who are contemplating on an investment in a business would like to know about its profitability and financial position. They derive this information from accounting reports of the concern. Prospective investors are people that are interested in putting their money in your business. And of course, they are interested in how much are they going to get back in terms of profitability, in terms of return on their investment. Then also, they want to know the position of the business. Will this business continue to operate in the foreseeable future? So these are some of the areas that are of interest to them. Then we have creditors, bankers, and other lending information. Of course, they are interested, all this set of people, creditors, bankers, other lending institutions, they are interested in the business, whether the business will be able to pay back their money or not, whether the business is in a good position to discharge its financial obligations. Then we have governments. Governments are interested in financial statements of the business enterprise on account of taxation, then also on labor and corporate laws. They want to be sure that you are complying with laws. There are specific provision of CAMA regarding preparation and presentation of financial statements. Government wants to, see whether you are complying with those laws. Then, of course, they are interested in your financial information to determine how much of tax that you are going to pay. Then, employees are interested in financial statement because it increases their salary. Because increase in their salaries and wages and payment of bonus depend on the size of the profit earned. So it helps them to negotiate for increase in salary or increase in commission. So this is what employees use financial information for, or accounting information. Then regulatory agencies, various government departments and agencies such as corporate affairs, tax authorities, they make use of reports, not only for the purpose of tax assessment, but also in evaluating how well various businesses are operating under regulatory legislation. For example, banks are mandated to submit their financial information at a particular time to the CBN. So CBN is not a tax collection or whatever, but they are a regulatory agency. So there is a mandate that by a particular time of the year, all financial information of banks must be submitted to CBN. So they need it for evaluation to know, how some of these businesses are doing. For example, like CBN that I mentioned, it's actually from this financial information that they know whether any bank is in distress. These are the areas they carry out some tests to see whether their existence is threatened or not. So it is from their statement they come up with, this idea that this bank, the viability is not guarantee anymore. Then researchers, accounting data are also used by researchers, scholars in the academic environments to do their research, accounting theory as well as the business affairs and practice. Accounting information are used by scholars in the universities to do research. The customers may also have either short-term or long-term interest in the business entity to know the profitability, liquidity, and solvency of the business. I remember I was working with a company sometimes ago, and we were marketing a particular customer to start buying a product. And the man said, if I request for 6 trucks of your products, how long will it take you guys to, to supply? So there are some big customers that want to know whether you actually have capacity to meet them, especially to meet their demand, especially those that are big consumers. They don't want you to disappoint them. The only information or the only thing you can use to prove that to them is from your financial record, to prove to them that you have the capacity. So they are also interested in your accounting information. And briefly, let's look at source documents. Source document. These are primary or initial documents used to record or capture business transaction immediately they take place. Immediately they take place. They are evidence that transactions actually take place. The documents are used to record transactions in various books of accounts. Now, source documents are very, very essential in accounting. It's an aspect of bookkeeping anyway, but it is very, very essential because everything you are going to be recording in your financial record, the evidence that those figures actually exist are your source documents. So the importance of source documents cannot be overemphasized in accounting. It is very, very key. There are evidences that transaction actually took place. And examples of source document that we have the invoice, we have debits and credit notes, we have the receipt, we have bank tellers, we have pay slip, we have check stub, we have payment voucher, we have purchase order, we have sales order. What I will do is maybe in next video I'm going to do, I will get a copy of some of these documents each, a picture of it, and put it up for our understanding. So these are some of the examples of the source documents. The invoice is the evidence that sales takes place, which is evidence that sales takes place. Debit and credit notes. Debit and credit notes can be used from the point of you as a customer or the point of view as a supplier. Debit notes is actually raised to correct undercharge in customers' accounts. Then while credit notes is used to correct overcharge, or if there is a return of items by the customer. So invariably, debit notes is used to debit customers' account, while credit notes is used to credit customers' accounts. The receipt is an evidence of cash payments. What you issue when you receive cash from your customer is receipt. That is evidence of cash collection. Then you have the bank teller, evidence that, or bank teller or pay slip, evidence that you make a deposit in your bank account, or you make a deposit in your supplier's account. It's evidence of deposit in the bank. You have the check stub. The check stub are the small parts you have in your checkbook after you have detached the check leaflet. The payment voucher, this is an evidence that payment is made. When you make payment to a supplier or whatever, you raise a payment voucher to show as an evidence that payment is made to the beneficiary. Then purchase order, then you have sales order, etc., etc. Okay, I think for the purpose of this class, we are going to stop here. Then in the next class, we're going to look at accounting principles, concepts, and convention. Then we'll look at some of the questions that have been set by WAEC. Now, while I was going through WAEC examiner review, I saw from the examiner comment that students in WAEC perform, I think 2008 or 2009 examiner review, I can't remember the year. This particular topic that we're discussing, a lot of students, majority of the students perform so woefully because they commonize this particular topic. Generally, account students disregard this aspect of the, I don't know, maybe it's because it's full of theory, but there are examinable areas. In 2018 and 2019 alone, 2019, there are about 8 objective questions that are set from this topic. The same thing in 2018. Some of the questions I'm going to share with us. So I will advise that we pay particular attention to this particular topic. You can imagine if you score just one topic alone, you have gotten already 8 marks in your objective test. So let us pay particular attention to it and let us take them seriously. We tend to concentrate our attention on only the calculation. So all these parts too, they are very, very important. Thank you very much for your time. I'll be dropping this video for our consumption on occasion. Thank you for watching and listening. Yes.